right? So nothing to worry about at this point, right? Future looks bright, our metrics are strong, we're on the right path. Fast forward a few years and the wheels have almost entirely fallen off. But the moment that ARR growth rate starts to slip, they're going to have to rein in those operating losses, right? There's nothing that the public markets hate more at the moment than a company whose growth rates are decelerating aggressively, who are still running really large operating losses. When I think of Asana, the first thing that comes to mind is kind of low ARR growth and large operating losses. All right, final thing we're going to cover off today is a sneak peek of the first metric from our Q2 State of SaaS report. And the one we're going to look at is ARR growth rates. Now, to be fair, we expect to see growth rates decline over time, right? Because as these companies get larger, maintaining high growth rates off a larger base is harder to achieve. But what we don't want to see is a decrease of 20% across a 2-year period. Welcome to episode 29 of the SaaS Report. I'm your host, Matt Aird. And today we're going to be looking at Q2 results from Rubrik, Asana, PagerDuty, and UiPath. And then we're going to take a sneak peek at the first metric from our Q2 State of SaaS report, and that's going to be ARR growth rates. So we're going to have a look at the ARR growth rates for the basket of companies that we track and how those have been trending over the last couple of years. So let's get into it. PagerDuty reported Q2 numbers recently, and they are turning into a bit of a case study into what happens when ARR growth rates decelerate. In Q2 of this year, they posted just 6% ARR growth year over year, adding just 30 million in net new ARR over the last 12 months. Now, if we rewind back to Q2 of 22, things looked really good for these guys. 360 million in ARR, growing at about 34%. They also had 27-month CAC payback and net revenue retention of 126%, right? So nothing to worry about at this point, right? Future looks bright, our metrics are strong, we're on the right path. Fast forward a few years and the wheels have almost entirely fallen off. They spent $203 million on sales and marketing in the last 12 months to generate 30 million in net new ARR. That gave them CAC payback of 96 months over the last 12 months. RPO growth, which is kind of indicative of future revenue growth, was only 5% year over year. And net revenue retention rate has collapsed, right? From the high of 124% in Q2 of 22 down to just 102% in Q2 of this year. There is one silver lining, and that's that they've managed to improve operational efficiency of the business. Free cash flow margins came in at 24% in Q2 this year. That's up from 1% in Q2 of 22. And this was also their first quarter of positive operating income margins. So they generated a 3% operating margin compared to negative 14% a year ago. So it's going to be a tough road ahead for PagerDuty, but at least now with that free cash flow margin and the operating margin in positive territory, they're in control of their own destiny. They're trading at just 3 times Q2 ARR. Rubrik posted 55% ARR growth in Q2 year over year. Only Applovin grew faster than them in the 40-odd public SaaS companies that we track. That 55% ARR growth to 1.19 billion in ARR, that represents 423 million in net new ARR year over year. They generated that via 658 million in sales and marketing spend. Now, historically, Rubrik hasn't been a company that's shy about spending money on sales and marketing, but they began to taper that off in Q2 of last year, from 82% of revenue in Q2 of 24 down to 59% of revenue in Q2 this year. Now, that's still high relative to some of the other companies that we track, but not as extreme as we saw in Q2 of 24. Now, despite that really aggressive sales and marketing spending, they still have pretty efficient go-to-market metrics. CAC payback over the last 12 months came in at 23 months and magic number came in at 0.64. They've also made some strides in overall business efficiency over the last 12 months. So in Q2 this year, that represented the 4th quarter in a row of positive cash flow margins. So they had free cash flow of 19% in Q2 and an average free cash flow margin of 17% over the last 4 quarters. That's up from an average of -7% in the preceding 4 quarters. So a good job improving free cash flow margins there. The one problem area for Rubrik at the moment is operating margins. They're running massive operating losses in comparison to their peers. Operating loss came in at 30% in Q2, whilst the median for the companies that we track is -3%. But they are making some progress here, right? We're starting to see this operating loss by quarter number reduce quarter after quarter, which is a good sign for them. Now, these negative operating margins won't hurt their valuation multiple as long as they can maintain their growth rates. But the moment that ARR growth rate starts to slip, they're going to have to rein in those operating losses, right? There's nothing that the public markets hate more at the moment than a company whose growth rates are decelerating aggressively, who are still running really large operating losses. So Rubrik's valued at about 16.2 billion at the moment, which is about 14 times Q2 ARR. We got Q2 numbers from Asana recently, and Asana is one of these companies that has just been going sideways for the last few quarters. When I think of Asana, the first thing that comes to mind is kind of low ARR growth and large operating losses. Not a great combination for a SaaS business, but they may have turned a corner. So Q2 ARR growth came in at 10% year over year. Whilst that's not setting the world on fire, it is up from the 9% in ARR growth they reported in Q1 of this year. And on top of that, operating losses have improved significantly from -43% in Q2 last year to just -25% in Q2 this year. Now, we may be starting to see some impact from their new CFO. So Sonali Parekh, apologies if I've pronounced that incorrectly, she previously helped RingCentral to double operating profit whilst maintaining double-digit revenue growth past $2 billion in ARR. Now, that's basically the same task that she has for Asana at the moment, right? They're at around $1 billion in ARR. They need to maintain ARR growth rates while at the same time improving business efficiency. So very similar challenge to the one that she faced at RingCentral. Now, I think the bigger of the two challenges here is going to be, how does Asana re-accelerate ARR growth after this wicked ARR growth deceleration that we've seen over the past few quarters? The improvements that they've made on operating income over the last few quarters come about through pretty aggressive cuts to R&D and sales and marketing. So we can see on this chart here, spend on sales and marketing has gone from kind of north of 80% to just below 60% of revenue. And spend on R&D has gone from about 57% of revenue down to 42%, right? So one part of that equation is heading in the right direction, right? They're getting operating losses under control. But again, the bigger question is, how are they going to re-accelerate ARR growth? The man tasked with answering that question is Daniel Rogers. Rogers took over as CEO from Dustin Moskovitz in July of this year. He's worked for a who's who in B2B tech with stints at AWS, Salesforce, Microsoft, and ServiceNow, where he served as the CMO for almost 4 years. Most recently, Rogers held the role of CEO at LaunchDarkly. Now, the two focuses for the business at the moment seem to be on improving retention, right? So reading through the transcript of the Q2 earnings call, that's a big focus for them, is how do we improve retention rates? They saw some progress here with the highest logo retention in the company's history and a slight improvement in NRR as well, from 95% to 96%. And then the other angle on increasing ARR growth rates is to move up market. Their customer cohort growth, so customers spending more than $100,000 per year with them, the number of customers spending that increased 19% year over year. So some positive signs for Asana, right? But still a lot of work to do to get the ship headed in the right direction. They've got a market cap of $3.28 billion, or about 4 times Q2 ARR. CAC payback of 56 months isn't ideal. That's the go-to-market efficiency story for UiPath at the moment. 172 million in net new ARR over the last 12 months, with 718 million in sales and marketing spend. So they saw ARR growth rates decrease from 19% in Q2 last year down to just 11% in Q2 this year. Now, the story here is again one of a pretty aggressive ARR growth rate deceleration over the last 2 years, down from a high of 44% in Q2 of 22. Now, as we've discussed here on the podcast at length, when your ARR growth rate slows, net new ARR added also slows, right? And so when that happens, go-to-market efficiency decreases. So UiPath have been fairly aggressive at cutting sales and marketing budget in response. Sales and marketing spending as a percentage of revenue is down to 46% compared to 61% a year ago. And they also had pretty substantial cuts to R&D over the same time period as well. So that's down to 27% from 31% of revenue a year ago. So that gives them a much more kind of palatable operating margin profile. So operating margin came in at -5% in Q2 this year compared to -33% in Q2 last year. So some good strides there. Last quarter, UiPath, they announced this kind of shift in the focus of their kind of go-to-market model, wanting to pursue larger customers that have the propensity to kind of spend more with them over time. Now, looking at the net new customer adds of customers spending more than $100,000 per year with them, right? It's hard to say that we're seeing this strategy bear fruit just yet, right? We're not seeing any significant kind of spikes in the trend here, but this is going to be one to watch for them over the next few quarters, right? They also indicated that this metric is looking healthy from a pipeline perspective, right? So they've got deals in the pipeline that haven't moved through into close one yet, but some good positive signs for them kind of further up the funnel at this point. UiPath currently has a market cap of about 6.4 billion, or about 3.8 times Q2 ARR. Right, final thing we're going to cover off today is a sneak peek of the first metric from our Q2 State of SaaS report. And the one we're going to look at is ARR growth rates. So for those of you that aren't familiar with the work that we do here, every quarter we put out a report that breaks down about 40 odd public SaaS companies across 15 core SaaS metrics, right? So what we do is we go and crunch the data from all of these quarterly reports, and we pull out all of the information that you want to know, right? Things like ARR growth rates, CAC payback rates, magic number, free cash flow margins, ARR per employee, right? It's all in the report. And what we do is we stack rank these companies across these metrics and then look at some of the trends in the data over the last couple of years, right? So the first one that we're going to look at today is ARR growth rates by company. So Applovin was the clear winner here in Q2, growing ARR at 77% year over year. So they added $2.19 billion in ARR year over year, taking them north of a $5 billion run rate. Rubrik, who we covered earlier in today's pod, came in at second place. They had 55% ARR growth year over year. And Palantir, the company of the quarter in many ways, right? They kind of were the company that grabbed most of the headlines after their Q2 earnings announcement. They rounded out the top three, coming in at 48% ARR growth year over year. So Palantir added about 1.3 billion in ARR, which took them north of 4 billion in ARR. Now, when we zoom out and look at these ARR growth rates over time, right? In Q2 of this year, the cohort of companies that we tracked had a median ARR growth rate of 20%. Now that is down from 23% in Q2 of last year and down from 25% in Q2 of 2023. That's a 20% decline in ARR growth rates over the last 2 years. Now that's a problem for the SaaS industry as a whole, right? Now, to be fair, we expect to see growth rates decline over time, right? Because as these companies get larger, maintaining high growth rates off a larger base is harder to achieve. But what we don't want to see is a decrease of 20% across a 2-year period. Some of the big movers here, right, and we'll look at these from both a positive and negative side of the coin, right? There were some companies that delivered massive ARR growth rate increases year over year. Applovin was one of the big increases here. They went from 44% ARR growth in Q2 last year to 77% in Q2 this year. Palantir climbed to 48 from 27% last year. ZoomInfo off a low base, right? But they almost doubled their growth rate from 3 to 5. And Box had a big increase as well from 3% ARR growth rate last year to 9% this year. From a downside perspective, there was also some big movers. So Atlassian's growth rate decreased from 34% down to 23. CrowdStrike went from 32 down to 20. SentinelOne went from 32 down to 22. And Zscaler went from 30 down to 21 year over year. All right, so what this shows us is that even for some of the best companies, right, and you'd put companies like Atlassian and CrowdStrike in that bucket, it's very hard to maintain ARR growth rates in this environment. Now, if you want more data like this, I am putting the finishing touches on the Q2 State of SaaS report as we speak. So that should be out in about the next 5 days. I'm going to put a link below this to sign up for the State of SaaS newsletter. If you subscribe to that newsletter, as soon as the report is done, it will land in your inbox. And again, we'll be covering things like ARR growth rates, magic number, CAC payback, free cash flow margins, right? For all of the SaaS companies that you care about. So if you want to get that report as soon as it's done, go subscribe to the SaaS Report newsletter and you'll get it in your inbox as soon as it's ready. Thanks for tuning in this week. I'll see you here again next week. Until then, goodbye.